Thanks for tuning in to part 2 of our discussion on We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement. We cover steps 6 through 12 in this presentation. Steps 1 through 5 were released last week in part 1 and are available for you to view right now. I recommend that you have a look at part 1 if you haven't yet seen it. You can find the link to part 1 in the description of this video or podcast. I hope you enjoy part 2 of our deep dive on We're Talking Millions. We'll jump right in and start at step 6.
At number 6, choose index funds over actively managed. And of course, I know intuitively, I know that there is well over 0.5% there, because almost all the good things I want in a mutual fund come in an index fund and are not in an actively managed fund, like broader diversification, like lower expenses to manage, like lower turnover, like lower taxes. I mean, it's all over the place. And because we are talking about how much we have to live on and to leave to others later in life, when I see that over 20 years, that only about 1 out of 10 actively managed funds is able to do what an index fund is, and that is to match basically at a very low expense the benchmark itself. And to make matters worse, when you look at those long studies, and they're updated every 6 months, when you look at those studies, you're going to see that there's those managers in the upper quartile, and then there are managers in the third and the second and the first quartile. Now, you might believe that all the managers in the bottom quartile have always been in the bottom quartile. No, many of those managers have actually been in the upper quartile, but now they're down there. And not only are they not reaching the return of the benchmark, they are as much as 2% a year below for 20 years. So this is really a big decision. Not as big as stocks versus bonds, but once you made that decision to be in stocks, boy, indexes, I think, are the way to go. So what have you got in your calculator?
Yep, so we're in the same scenario, and I was speaking with an advisor for my parents, actually, and I asked what their expenses were, and it looked like it was about 1% per year, which seems to be kind of an industry standard. Yeah. So we've talked about passive index funds, but the expense ratio that you would pay in an actively managed fund could be a 1% or 2% additional expense compared to a passive fund. So we're going to use the same field of change historical returns by, and we're going to change it by a -1%. And since you saw in the last step that 0.5% was $300,000, 1% compared to that 2.6,
without be 600.
Yes, it's $600,000. So again, the more that you can save in expenses, total expenses, passively managed index funds versus actively managed index funds, you're talking a couple $1 million saved right there.
And you know something, Craig, you and I are working for do-it-yourselfers. Now, we're also working for people that maybe they're not do-it-yourselfers, but we're thinking that maybe someday we could convince them to take 10% or maybe 20% of their portfolio and do it themselves. And once they get the swing of it, it's not very difficult to put together a buy and hold portfolio of low cost, broadly diversified funds with great long-term track records. I mean, that's what we'd like to have in our portfolios. And so those kind of people we're hoping that we can get to as well. But what I like about your calculator is that you can sit down and figure out, okay, these 12 things that Merriman talks about, Buck talks about, now Craig talks about, These 12 things don't even include the 1% that somebody like your parents, and I don't know this, but somebody like your parents will pay people to help them buy the right actively managed funds that are costing them 1% a year, which means that it's not unusual if you could put a -1 in there because people are using actively managed and having somebody help them do that, that you could put another -1%. And then you say, what does this mean to you, your family, what you leave to others, what you're able, the experiences that money translates into over your lifetime? And you can celebrate. And that's the beauty of your calculator. I just talk. You actually work the numbers and people can see and make notations. Oh yeah, oh yeah, oh yeah. This is worthwhile learning how to do. Anyway, I digress.
I had one additional point here on robo-advisors. I was in a robo-advisor for a while, and that was actually before I found the foundation here, because it felt, why not? If I put my money in and I say that I want a particular allocation, why not let a computer or an algorithm figure out how to stay in that allocation? And so the one that I was in actually would rebalance if my allocation had drifted plus or minus 3%. And in order to do that, they charged me 1/4% fee of my portfolio at that time. So I wanted to just note that you can put 1/4% in this. So again, if you were to take a negative 1/4% off the top,
let's do it.
It's not $1 million difference, but it's I guess I was at 2.6 and without that reduction, and the 40-year period at the end of it with 1/4% taken out is 2.4. So we're about $200,000 there.
That's great. That's terrific. And next we have the oh, by the way, I know what triggered the thought there. They get out of balance by 3%. The longer you wait to rebalance, the higher the return.
Right.
So that's maybe rebalancing too often and causing you a lower return due to the rebalancing. When you rebalance, it's not all free. They don't have to charge a commission, but there's still internal costs to do that. All right, so now we're down to number 7, and that is adding small companies to your portfolio as an asset class. We know historically large cap blend makes around 11%. That's the average 40-year return for large cap blend going back to 1928. Small cap blend, which is some growth and some value, as large cap blend is some growth and some value, but large companies versus small, there is about a 2% difference in return over the long term. So that's a meaningful thing to have in your portfolio. Now, how do you represent that? I mean, do you when you use your calculator?
Right. So our the foundation's fine-tuning tables don't have a small cap only fine-tuning table. We have many strategies. The 4 fund would be 4 different asset classes. Ultimate buy and hold, of course, is 10. We have a small cap value, we have an all value, but we don't have a small cap only. So I actually am going to use Portfolio Visualizer again, but I'm going to use a different test. And I'll go ahead and share my screen again. Again, we're on portfoliovisualizer.com. And in the backtest portfolio, we're going to click on backtest asset allocation. And so what this allows us to do is it allows us to look at asset classes from 1972 to 2021 so that we can compare US large cap, which is the S&P 500, versus a small cap only asset class. So we're going to do a 40-year period, as always, so 1972 to 2012 or 2011, I believe. Our initial investment is going to be $5,000. And we're going to do $5,000 of contributions, not scaling for inflation. And we're going to choose, our first asset class is going to be large cap. And our second asset class is going to be small cap. I just wanted to show the distinct difference between these two asset classes. So in asset one, I'm going to choose US large cap, and I'm going to put that into portfolio one at 100%. Asset two, I'm going to do US small cap, and I'm going to put that in portfolio two at 100%. Double check my numbers. All right, looks good. And I'll go ahead and analyze the portfolio. So you can see here, again, this graph, the red line is the small cap only asset class, and the blue line is the large cap only asset class. Again, we're on a logarithmic scale, so they look very close to each other. But if you look up at the table, your compound annual growth rate of the small cap was 18.5% over the 40-year period, and the large cap was 16.8% over that period. Your final balance for small cap is $4.4 million, and your final balance for large cap is $2.4 million. So that's $2 million over that 40-year period if you were 100% all in small cap compared to being 100% all in large cap. And you know, we're looking for $300,000 here. So we have multiple millions of dollars just by choosing small cap.
And in our portfolio, Craig, my wife and I, we have in the equity portion, we have half in small and half in large. And if you notice, the maximum drawdown for the large cap was about 51% and about 54% for small cap. So the risk factors, even though they are different day by day, by the way, if you do not follow the Morningstar daily style box returns, you may be surprised if you do to find out that in one day you can have 1, 2, even 3% difference between different style boxes in the U.S. market: large growth, large value, large the core, and the same thing with mid and small. And it surprises me how in one day there can be these huge, if you annualize those difference in returns, they would be gigantic differences. But this is a meaningful difference. I think it's also, there's an interesting lesson here. I don't know how to look at it in terms of the logarithmic aspect of this, but notice that there are periods that you don't get any premium. I mean, they basically do the same. And then you'll get a spurt, and then that sometimes it reverts back to that mean. Notice it doesn't seem to go below the large cap for very much. Now, I may be misreading the chart here, Craig, so correct me if I'm wrong.
I think you have it right, but I'd also like to point to, didn't you have a recent presentation on small cap value that showed that difference exactly?
Yes. Oh, yes. For long periods of 20-year periods, it will make the same return basically as the S&P 500, and then wham! I mean, it's just huge rocket takeoff for a year or 2 or 3 sometimes. But yes, they come in spurts. Got to be there. That's great. That's starting to make the $1 million credibility list for me anyway. Thank you, Craig.
Yep.
Then, of course, number 8, huge, and that's value. Large value, small value. Craig mentioned earlier, value out of favor companies that are not the darlings.